So the two main risks or potential people that will sue a company are clients and employees. So if you have them separated from your assets, then you've got that. It doesn't mean you're 100% protected, because there's no 100% protection out there, but it means you're more protected than what you can be.
This is the Business Owners Smashing It Online podcast for entrepreneurs and business owners looking for cool online tools, apps and strategies to make business easy online. My name is Nick Cree and I'm your host. Each episode features a guest expert demystifying the online universe, sharing inspirational ideas and providing tested real-world strategies to help you get the most of what's available online to grow your business today. Don't be a slave to your business, get your business working for you. Subscribe now and get some great content and ideas for you and your business today. So tonight's guest speaker is Roger Hawley, who has been dubbed the underground accountant. Well, actually, I dubbed him that, but Roger's actually been my accountant for many, many years. And the reason why I like Roger, apart from the fact that he drinks incredibly good 100-year-old whiskies, which is always good to go around and share that with him, which is why I always like to go around at the end of the day to visit Roger rather than early in the morning, because I'm more likely to get a good shot of whiskey then. But apart from that, Roger is an accountant. He has owned and run accounting practices. But more than that, he has also been a business owner as well. Well, accountants are business owners too, but he's actually run some other businesses like butcher shops. He's been really successful running butcher shops. He's been in solar and RTOs and in training business as well. So Roger's here to talk to us about the topic of structures and what sort of business should you run your structure in? Should it be a company? Should it be a trust? Should you run it as a sole trader? And in fact, should you be running? Should you change structures partway through? What are the hidden risks and dangers in all that? And the reason why I've got Roger on to talk about this is that he's worked on this for many, many years with small business, and being a small business owner himself, he understands inherently some of the risks and some of the benefits of the various structures. So let's put your hands together and give a warm virtual welcome on stage here, Roger Hawley.
Well, hello everyone. I'll just get my presentation up here. Okay, so thanks for that, Nick. And I've been on a couple of Nick's calls in the past, so I'm not sure if people have noticed me lurking there. I've never been really that active, but I've certainly enjoyed it. I've given this business structures talk many times over the years, but this is actually the first time that I've done it virtually, so you'll have to bear with me as we go through that. So firstly, so tonight this is a basic agenda here. I'll just give a brief introduction of myself. I'll go through the four most common business structures that we have here in Australia. Plenty of time for questions, because I imagine everyone will have a different structure, different business, so you'll need to know your questions will be customized to your own circumstance. And then I'm running a workshop at the end of the month, so I'll talk a little bit about that. So a little bit about me. So I think just about everything that Nick said was untrue, but I do appreciate what he said. No, that's not true. Quite a lot of it was true. So I've been working as an accountant for about 25 years. So I'm a chartered accountant and a tax agent, and I am very passionate about small business. So I guess when I first started out, I was very tax focused as an accountant, which served me well when I was an employee and working through the grades. I started out with KPMG. I did some time at Ernst & Young, and that all went very well. And I guess whenever you take a course or you get some advice or something like that, one day it struck me because they always say, before you act, refer to your accountant or professional. And then I thought, hold on, I've been an accountant for about 8 or 10 years it was at that time, and I actually knew very little about business. So I thought, gee whiz, if I'm supposed to be the professional here that people have to refer to, then you're in a lot of trouble. So I actually made the step to actually go out and buy businesses other than accounting businesses for the sole purpose of actually learning how to run a business. So the first one I bought out was a butcher shop based here in Brisbane. It was a very distressed business. It had actually gone under. So I bought it out of liquidation, turned it around. At the time of liquidation, it was turning over around $8,000 a week, something like that. It was quite small. And in about 12 months, it was turning over between 30 and 40,000 a week. So it was quite substantial growth. But obviously I'm not a butcher, and I didn't go in and cut any meat or anything like that, far from it. I was able to go in there and implement some simple business acumen within the business, and was predominantly a focus on sales and marketing, but then also a just-in-time inventory. I think they were the two things that did it. But what it did for me was it was able to broaden my skill base from being just a mere tax advisor that you only want to talk to once a year, to being an accountant that you can talk to all the time about your business and the different things that go on within business. Then I had my own accounting practice up until 2011. 2021. I beg your pardon. So I sold that. So I've actually been out of having a bit of a short break for a period, and then about 2 months ago, I started up a new company called Skillstorm. So I've partnered up with a e-commerce guru by the name of Pete Spinder, who's actually been a guest speaker on Nick's show a couple of times in the past. So a couple of you may be familiar with Pete. And we're going to provide training courses focused on e-commerce, which Pete will take, and then knowing your numbers, which I will take. And I'll talk a little bit more about that later in the slides. But that's skillstorm.com.au. So if you do a Google search for Skillstorm, it may come up with skillstorm.com, which is actually a completely unrelated business which operates in America. So make sure you put in the .au. Alrighty, let's jump into the common business structures in Australia. So you can see them as sole trader, partnership, company, and trust. I might just get a quick show of hands if people that are in business or want to go into business. Would you mind just popping into the chat which one of these four that you are? And if you're not one of these four, by all means put that in as well. I just want to see what people are. There's plenty coming through here. Oh yeah, we've got trust, company. There's lots of companies, lots of sole traders. We've got some companies and trusts. That's interesting. We might, definitely have a chat about that. So it looks like we've got no partnerships, which I'm happy to see that. Kappa Security. I'm not too sure what that is. That's an interesting structure there. All right, we'll move on to so what I'll do tonight is I'll go through the pros and cons of each one. Because there's no perfect structure out there, to be honest with you, but there are some structures which are better than others. So we can go through that. So the first one I want to talk about is a sole trader. That's the most easiest structure to set up. So you literally, as an individual, you just go onto ABR, aea.gov.au, register yourself an ABN, and away you go. You are in business from that time. And when you lodge your tax return, there's a sole trader section within the individual tax return, and it's very, very simple, very, very easy to do. And I would say the vast majority of people that start up a small business or a side hustle while they're still an employee would use this structure, or would be advised to use this structure. There's no ongoing maintenance fees, and the compliance is straightforward. The problems that we have with this one is there's no asset protection. Like, when you're running your business, you get sued, and the person that's suing you, if they happen to win, then they can go after all of your personal assets that weren't necessarily involved in the business. So that sounds scary, because it is. They have full access. If you're, like, for argument's sake, if you're running a business as a sole trader and then you own your personal home, then you're effectively putting your own home at risk, which is quite scary. So yes, it's easy to set up, but due to the lack of asset protection, or the problems with the no asset protection, it's usually not advisable to be a sole trader in business. Secondly, you cannot minimize tax at all. I'll put there, you can't minimize it effectively, but you can't minimize it at all, because it's effectively gets taxed at your marginal tax rate. So where it does work well, and this is one of the few advantages that a sole trader has over the other entities, is if you're running at a loss and you have a salary and wage as well, say for argument's sake, you've got a job, a regular job, and you're earning 150K, and then you're setting up your sole trader business and that runs at a loss, provided you turned over at least 20,000 in the sole trader business, you're then able to offset the losses against your salary and wage. So that is one advantage of a sole trader over any of the other structures. But to do that means that you're running at a loss. So it's an advantage when you're setting up. But I think the risk of having no asset protection outweighs that tax advantage that you may have there. The last one is perception. So this is something that I've come up with over the years. I've never seen anyone else talk about this. So what I mean by perception is this. So I'm going to ask a question out there, and I'd like you to answer in the chat if you know. If you're a sole trader and you're not registered for GST, which is often the common advice, what does that tell me about your business just from a basic ABN? If I do an ABN search on abr.gov.au, and you're a sole trader and not registered for GST, what does it tell me about you? Let's have a look in the chat here. So Zim's come out and says it's a hobby. Yeah. So John Cutler's nailed it. It means it's public knowledge that it's not actually earned, technically it's turnover. So it's public knowledge that you don't turn over 75,000 per annum. So if I'm starting up a business, do I really want my customers to know that about me? No, I don't. So yeah, so you really, the way you get around that as a sole trader is you register for GST regardless. That's if you're worried about the perception. But there are times when you shouldn't register for GST and you just suck it up that you're small. But for the most part, you want to be you don't want people knowing that you're earning less than, or you're turning over less than $75,000. So we've just got a couple of questions up here. What if your assets in your wife's name? Okay, so just bear in mind that I'm not a lawyer. Like I am an accountant. So getting the best advice in regards to asset protection, you should speak to a lawyer. But generally, if the assets are in your wife's name and your wife is not participating in that business, well then you should be safe, because your customers can only sue the person that you've got the relationship with. They can't sue unrelated people. So generally that would be okay. All right. I'll just go on to the next one. So next structure is a partnership, which over my 25-year career, I'm seeing partnerships less and less and less. It's very similar to a sole trader, but you have more than two people, or it could be two companies, it could be two trusts. So the pros and cons are almost the same, but it's a little bit easier to minimize tax effectively through a partnership than what it is as a sole trader, because you've got more than one person going through it. I haven't put it here because it's quite a complex tax outcome. But I guess the most effective use of a partnership that I've seen in my career is people that set up a partnership of companies. So that does sound quite complex, and I guess it is. But what that did was allow the directors to, I'll call it Div 7A, because you've probably heard accountants talk about that. So that's where you have a debit loan in a company. So to allow them to somehow avoid it, which I think if you set up a structure whereby it was a partnership of companies in the modern era, you'd get caught under the tax avoidance provisions and be caught under Part 4A. But this was set up pre then, so because it was technically a partnership and not companies, then they didn't fall foul of Part 4A. So that's very technical, and yeah, I'm not expecting everyone to understand that one this evening. But partnerships are not in vogue at all. But having said that, that should only be partnerships of individuals. Like, I wouldn't recommend that at all. But partnerships of companies and trusts could potentially allow you to work with other companies and create businesses with other companies. So I wouldn't discount that if you're looking to set up a business structure. Just got a question there. Yeah, so Azim says he's done some work with some joint ventures. So that's a different vehicle again than a partnership. So with a joint venture is you don't actually form a business structure. So you don't have your own TFN or ABN. Like, you come together and you keep your own identity, but you work together. So I'm not going to really talk about joint ventures tonight. John Cutler's asked if there are companies involved, do you recommend a partnership agreement? Absolutely. With any structure, if you're working with anybody, particularly non-family members, but even with family members, I recommend a partnership, or I recommend an agreement. So with a partnership, it'll be a partnership agreement. With a company, it'll be shareholders agreement. And with a trust, it'll be beneficiaries agreement. So having that agreement is very important. A lot of people go to lawyers to have them drafted, which that obviously gets you the best of the best. But when you're starting up business, spending $2,000 or thereabouts on getting an agreement written up is it's a lot of money for a lot of people. So usually most agreements end up being verbal. And when you have verbal agreements and something goes wrong 2 or 3 years down the track, it's very difficult to prove what was said and what was agreed on. So as Roz has come through, always have written agreements. I cannot agree with that strongly enough. So yeah, get it down in paper, but make sure that the written agreement can be adjusted as the business grows. There's no need to have it completely rigid and enforceable. Yeah, so that's good advice there. Rightio, we might move on to the next, because the next couple are more interesting than sole traders and partnerships. Computer's not so responsive. The next one we're going to talk about is companies. So despite what you may have read in the title for tonight's training, this is actually my preferred structure out of the 4 that I'm introducing tonight. But having said that, there's no one structure fits all. Like, it's quite important that you look at your particular business circumstances, where you want to go in business, what you have to protect, and then make a decision around the structure. It's much easier to get the structure right from day one than to change it later on. It is possible to move from a sole trader to a company, or a company to a trust, or vice versa, but there are administrative costs involved. In some cases, there can be capital gains. So my advice to everyone is, think about your circumstances as they are now, where you want the business to go, and then base your business structure around that. So I guess the 2 main things that you hear most commonly about a company, or the 2 main benefits that you hear, is your assets are protected, and the potential to minimize tax is heightened within a company. So let's talk about the asset protection there. Yes, it usually is protected in a company, or can be protected in a company, but it all depends. Nick and I were talking about this before the start of the show, and this is probably the area that a lot of accountants don't talk about. They just say the companies protect assets. But if you take the scenario where you run your business through just one company, i.e. all your engagements with your clients are there, you've got all of the assets in your company on the balance sheet, and there's really nothing else in there. It's just one company. So in that case, if you unfortunately are getting sued by one of your clients, then they can go after everything that the company owns. So what big companies do to get around that is they have multiple companies within the group. So they would have an operating company which effectively owns nothing, which deals directly with the clients. Then they would have an asset holding company which might have your trucks and your vehicles and any other assets that you might own, your plant and equipment that goes in there. So that has nothing to do with the clients that you deal with. And then you have the third company, if you're big enough, which employs all of your staff. So the 2 main risks or potential people that will sue a company are clients and employees. So if you have them separated from your assets, then you've got that. It doesn't mean you're 100% protected, because there's no 100% protection out there, but it means you're more more protected than what you can be. So it's got a couple of questions. I'll just see what they are. Yeah, John Cutler's said if you're a sole trader, having multiple entities is not a viable option. That's true. Having said that, though, as a sole trader, you can have multiple ABNs. You can run multiple businesses, but yeah, I've had the odd person do that. And Azim said, yeah, it doesn't protect a director from everything, which is quite true. That's one of the cons down the bottom there, and I'll get to that. So one of the big advantages of having a company, and this is particularly compared to a trust, which I'll talk about more when I look at the trust, is the ability to retain earnings. So what that means is, if say you've made a couple $100,000 profit in your company, which is great, you don't want to pay yourself that in a wage because it'll push you up into the highest marginal tax bracket. So you want to pay yourself some wage, but you want to leave some in the company. So then that'll get taxed at the lower corporate rate and stay in the company as a retained earnings. And then later on in future financial years, you can pay yourself a dividend. And if you've paid tax on that, you can pay yourself a fully franked dividend. So that means the franking component, or the tax that the company has paid, then flows through to you as a benefit when you receive that dividend in a future period. So that's a massive advantage to a company over a trust. So I'll give you an example of this is a personal example. So I ran my accounting practice through a company a couple of years ago. It went okay. I retained some earnings. I paid some tax. So now I can actually pay myself dividends, and because I don't have any other tax or any other income in my personal name this year, I'll actually get quite a lot of those franking credits back, or the company tax back that I paid in prior years. So that's the big advantage of being able to retain earnings. And then the flip side, and with perception, is if you've got a company, then you're the real deal. Like you're not a sole trader with a little side hobby. You've actually taken the time to spend some money, establish a company. It's a name usually different than your own, and you're a PTY Ltd. So when anyone's running a business, I think most of us would agree that if you're buying your goods or services off a PTY Ltd, then you feel that you're dealing with a bona fide business. Also, in regards to buying and selling your business, I know we're talking exit strategy now, which is quite important. The company is the easiest structure to buy and sell businesses. So the reason why that is if you're a sole trader, trust, partnership, then you can't actually sell the entity itself. You can only sell the underlying business. But with a company, you have the option of selling the underlying business or the shares in the business, which is a really good way of not necessarily, you can alter where the capital gains is ultimately taxed. Like if you've got a company and running a business and you sell the business, then the sale proceeds from that business will go into the company. But if you sell the shares of that company, then the sale proceeds go directly to the shareholders. So the tax consequences are completely different. And depending on your circumstances, you'd need to work out which one is best. And where that is quite interesting is if this company actually owns a lot of publicly listed shares. Like if you've got a company which has a whole stack of shares in BHP or Woolworths, CBA and the like, you can just sell the shares in the company. and then you don't have to actually sell all the individual shares of those publicly listed companies. So it just makes it a lot easier from an administrative perspective. On the flip side, they're more expensive to establish. If you're quite savvy, you can go on to, well, there's a whole stack of companies where you can register companies. I regularly use Register a Company or Company 123. You go on there and you can register it yourself. You've still got to pay the ASIC fees, which I think is around $600 odd now, 550, 600, something like that. And then normally you've got to pay a nominal fee to the website, which is between 40 and 60 bucks. So you can set up a company for around between 600, 650 bucks. But then if you're doing it yourself, and you're not consulting an accountant or a lawyer, you run the risk of making a mistake. They're going through an accountant, you'll pay anywhere between $1,200 to $2,000 to get that done. And then if you have a multiple group of companies, then you're looking at that fee multiple times. So if you want to just set up a group of 5 or 6 companies, you could easily spend $6,000, $7,000, $8,000. Then also with a company, there's a lot of directors' responsibility. So you need to conform to corporations law. So I guess the main responsibility there is to your shareholders. So you always have to act in the best interest of your shareholders, even if that shareholder is yourself. You can be a sole director, sole shareholder company, but you still need to act in what is deemed to be in the best interests of shareholders. So that puts a little constraint, I guess, on you, which you wouldn't have as a sole trader or in one of the other structures. And then secondly, there's ASIC. They send you these lovely bills every year just to keep your company registered. And each time you make a change to the company, whether you change your address or anything like that, you have to constantly update ASIC. So it can be a little bit tedious in that regard. And then companies are just generally more complex than sole traders, and because it has its own ABN, it has its own TFN. So if you have a company, when it comes to tax time, you need to lodge a tax return not only for yourself, but also for the company. So it's treated as a completely separate entity. Before I go into trusts, I'll just have a look in the chat box and see how we're going. Okay, Roz is asking, when did the sole shareholder, sole director come into being? Are you talking about what I was saying about the director's responsibility there? I don't quite understand the question. I'll go up to the...
Roger, I think what Roz may be referring to is a single director. When did a single director company come into being? Because for a long time, you had to have more than one.
Oh, okay. Now, provided sole director companies have been around for a long, long time, it only becomes problematic if one of the directors is a non-resident of Australia. Yeah, so provided the director is a resident of Australia, it's quite okay just to have a sole director. That's been in place for all of my accounting career, so at least 25 years, I would say. It may have been the case before that, I'm not sure. Okay, so Anthony's paying $639 to his accountant for the BAS every 3 months. Yeah, that's quick. You must have quite a few transactions there, Anthony, because that's quite expensive for a BAS. or maybe your accountant's just expensive. So Joe's asking, is there a benefit in having a sole shareholder of a company? Is a discretionary trust? Yeah, good point. So let's talk about that, because there is definite benefit there. So it adds a layer of complexity, but what it does is it allows you to pay dividends to shareholders and then distribute those dividends to the beneficiaries. I'm assuming the trust would be a discretionary trust. Sometimes they are set up as unit trusts, but usually they're discretionary trusts. So it then allows you, instead of, if you just had mum and dad as the shareholders, then they would have to take the dividends 50-50. But if you have a discretionary trust as the shareholders, then you distribute to this discretionary trust, and then the trustee can distribute that dividend how they see fit. Obviously, you minimize your tax as much as possible. So that's one of the advantages. And secondly is it's also protection. Again, when someone's trying to sue you, if the shares are owned in your name and someone's suing you, then that's an asset that you own, and they potentially will come after it. But if it's as a family trust, then the owner of a family trust is not as clear as a sole shareholder, or as an individual shareholder. So that makes it again much more difficult to sue the shareholders if they're owned by family trusts. So they're the two main reasons why you would own your company in a trust as opposed to directly owning it yourself as an individual. So I'll just move on to trusts. So again, there's quite a lot of trusts out there. I think there's probably 50 different types. The most common one that you hear the two most common ones you hear in business are discretionary trusts, or more commonly known as family trusts, and the other one's a unit trust. So we'll probably just focus on those two. I know there's a whole load of other trusts you can have, testamentary trusts and all sorts of things that you could have, but they're quite specific and probably outside the scope of tonight's discussion. But with a trust, similar to a company, your assets are protected. I've spoken to lawyers about that. What do they think? Are your assets more protected in a trust or a company? And they say it's much for muchness. Like there's no real difference there. You've got the potential to minimize tax. I guess the beauty of trusts is if you've got 120,000 of profit in your trust or business income, and you happen to have family members, adult family members, 6 of them that don't have any other income, you can distribute them $20,000 each, and because that's the tax-free threshold here in Australia, once you take into the lower income earners rebate, you can effectively distribute 120,000, disperse it out to family members, and not pay any tax anywhere. Like, it all sounds good in theory, but in practice, usually these family members are receiving some sort of Centrelink benefit if they don't have other income. So you have to be very, very careful as the trustee of a trust when you distribute income to other family members to make sure that they haven't received other Centrelink income, because if they receive a trust distribution from you, and they might necessarily have received the money, it might just be an accounting journal. They have to include it in their tax return, and they would potentially have to pay back Centrelink, even though they haven't received any money from you. So you need to be really careful in that regard. the cons, their trusts are more expensive to establish than sole traders and partnerships, but they're a lot cheaper to establish than a company. And you don't have to comply to corporations law. There's no director's responsibilities, and you don't have to answer to ASIC. So that's something that's one of the advantages of a trust over companies is the lesser responsibility. But one structure you do see a lot is having a corporate trustee instead of individual trustees. So that supposedly gives you the highest amount of asset protection if you want to go through the trust structure. So you have a company set up as a trustee for your trust. And if you're operating a business as a trust, whatever the business may be, like if the business is dealing with customers, then I would highly recommend that you have a corporate trustee structure in place. Because generally when trusts get sued, the person trying to sue you goes after the trustee. And if the trustee is an individual, they've got someone to sue. But if that trustee is a corporate trustee, then they generally won't try and sue that, because the key point here is to make sure that your corporate trustee doesn't own anything and it's never traded. I've seen that mistake quite often where people try and save money through setting up multiple companies. So they're trying to avoid that. So what they do is they have their trust, which is operating a business. Then they have a corporate trustee, which is great. But the problem is that corporate trustee, they also run a business through that. And that completely defeats the purpose of having a corporate trustee. So if you are running a trust with a corporate trustee, never do anything through that corporate trustee. It must sit dormant. Alrighty, so then the second con I've got there for trust is the inability to retain earnings. So this point here is probably the major reason as to why companies are my preferred business structure over trusts. If you're going to play small, i.e. your profit will never exceed 150,000, then it really doesn't matter if you're in a company or a trust. It doesn't matter in that regard, because if your profit is that small year on year, you're probably not going to retain earnings anyway. It'll be paid out as wages by the company to the directors and shareholders, and through a trust it'll just be distributed out. But where things can get tricky with a trust is when you become wildly successful and all of a sudden you've got profit of $500,000 to $1 million. With a company, it's fine. You just pay out the wages to the directors, to the upper limit of the individual marginal tax bracket allowed. But with a trust, you cannot retain earnings in that trust. So you need to distribute all of the income, which can become problematic if there's a lot of income to distribute and you haven't got too many individuals to share it amongst. So it can mean that you end up paying a lot of tax if it's distributed poorly. The way we used to get around that as accountants up until 2012 was to have called it was called a bucket company. It was called a corporate beneficiary. So the structure was you would distribute to mum, distribute to dad, up to the individual tax bracket, which is around the same as the corporate rate, and then the balance of your profit you would distribute out to the corporate beneficiary, and that would make your group tax or your group average tax around the same amount as having it all in a company. So that used to work well up until 2012, and then they changed the rules because the ATO didn't like that. So they changed it so you have to physically transfer cash into your corporate beneficiary to make that an allowable distribution to a company. So that threw most people. So that from that point on, that's when most accountants and lawyers started advising companies over trust. But having said all of that, my general rule in deciding whether you're a sole trader, partnership, company, or a trust really comes down to where you want to go with it. Like if you're running something that's bordering on a hobby / business, then yes, go with sole trader, because it's probably the only time you would want to be a sole trader. If you're running a business that is going to grow, or you expect to grow it, and you're dealing with customers, then absolutely do it through a company. But if you're looking to acquire assets, that might be real estate, might be shares, it might be other businesses, then the trust is a perfect vehicle to do that. And the final con I've got there for trust is the tax law governing trusts is extremely complex, far more complex than company tax law. Well, before I talk about the workshop, I'll just check to see what questions we've got. So Joe, in a trust, can you get the same effect of retained earnings by setting up a bucket company as a beneficiary? No, you can't. Because you probably asked that question before I explained the necessity to have to actually transfer the physical money to the company, which becomes problematic. You could set up a Div 7A loan, but I don't know why you would, because they're the interest rates on that are quite prohibitive. And then you also, your accounting fees will also go through the roof as well, because they'll set up a Div 7A loan agreement, which is a 109N loan agreement. They're quite easy to set up, but clients don't know that, so it's just another reason accountants will charge you more money. So try and avoid Div 7A loans where possible. Any other questions on structuring? So I'll just start introducing a workshop that I'm going to be doing later in the month. So just in regards to structuring, so feel free to shoot the questions through, and then I'll answer them once I've briefly introduced the workshop that I'm going to do later in the month. So I've teamed up with the e-commerce guru, Peter Spinder. He's been a guest speaker on this show a couple of times before, so a couple of you may be familiar with him. But we're going to split this over 2 days. So we're going to do e-commerce on day 1, and then know your numbers on day 2, which I'll be taking. So Pete actually started his first e-commerce business in the late 90s, which I'm pretty sure, I'm a fairly analog guy. I'm pretty sure I didn't even know what the internet was in the late 90s, let alone running an e-commerce business. So he's done multiple e-commerce businesses, and so he's going to spend the day demystifying digital businesses, looking at different business models, and then just getting started. Like, you'll be able to walk away at the end of that workshop and know how to, well, you'll have the tools to get going in the e-commerce world. Then day 2, so that's the 30th of June, which is a Friday. And day 2, I'm going to be, so we're shifting from e-commerce to a numbers focus. So I guess this is something I've always wanted to do. I've spent 25 years focusing on tax, and yes, tax plays a part of running a business, but it really should be treated as a secondary component when you're running your business. It never should be the primary focus as to why you would make a business decision. The primary focus is making money. So in order to make money, you need to understand your profit and loss statement, like how your sales fit in, how each expense fits in how each expense, or why each expense is necessary in order to generate you more sales. So I'll be going through all of the income and expense items on a typical profit and loss statement and explaining to people what you need to know so you can understand your profit and loss statement better. Then I'll be moving on to the balance sheets. And most people know something about their profit and loss statement. Like it's more understood than the balance sheet, but there are a lot of people that just ignore the balance sheet altogether because they simply do not understand it, which is quite a big mistake, because my belief is the balance sheet's more important than the P&L. The P&L is a momentary snapshot of the result of your business for that given period. The balance sheet is an accumulation of your worth. That's your true value. So maximizing your balance sheet as you grow your business is more important than actually than growing your profit and loss every year. Because when people buy and sell businesses not on what you're making every year, but on the perceived value of the goodwill in the business. So that's what needs to be maximized. And another thing I like to do with, I like to teach my clients, and I'll be going through in this workshop, is how to calculate your fixed costs. So this is quite an important number. So when you're doing business, you need to know how much you spend on a monthly basis before you've even made a sale. This could be if you're in a small service industry, it might only be $1,000. If you're in manufacturing and you've got high overheads, it could be $100,000 per month. So first and foremost, you need to calculate that number. Then you need to work out, based on your sales, at what point in the month do you cover your fixed costs. So if you're covering fixed costs by day 10, then you've got a wildly profitable business. But if you're not covering your fixed costs until day 29 or day 30 of every month, then you're only going to break even. But if you're not covering your fixed costs at all, then you're losing money. So that's having an understanding of your fixed costs is paramount to business. Then I'll also be taking through people how to correctly price your product. Having your product too expensive, too cheap, are both very detrimental to your business. Then also, I'll be taking people through, the importance of sales and marketing and how much you should, depending on what industry you're in, but how much you should be spending as a proportion of your sales within that business. So I'm a big believer that business is 80% sales and marketing. I'm a finance guy, sure, but that only comprises of 10% of your business. And then the other 10% is your operations. So, those percentages will fluctuate a little bit depending on whatever industry you're in. But the vast majority of the success of any business will come from their ability to sell and market their product or their service. So this is an in-person event. So it's in Brisbane. Full details are on the skillstorm.com.au. So yeah, I'd love you to all have a look. And if you're in Southeast Queensland, Brisbane, Gold Coast, by all means, come along. At this stage, it's just in person. So this is actually our pilot workshop. So if everything goes swimmingly, then from the second workshop onwards, we'll have hybrids, whereby we'll have the ability for people to come in person and then also log in remotely. But for this very first one, we're just having an in-person event. I'll just check the chat box. Oh, thank you, Nick. Nick has been kind enough to throw the website up there. Clicking to the next slide. So we're at questions. So people have been shooting questions through as they've gone. So that's the end of my presentation tonight. So thank you all for listening. But is there any final questions before I hand over to Nick? I'll hand back to Nick. One coming through. Where in Brisbane? So it's most likely at this stage going to be the Tingalpa Hotel. And I'll just put in my phone number there. So that's my mobile number. Yeah, Tingalpa Hotel, Brisbane. And that's my mobile number. It's like if anyone has any questions in regards to structures, then yeah, give me a call. Well, I might hand back over to you, Nick.
Excellent. Thanks, Roger. So hopefully that's given everyone a good overview as to what these business structures are, what to do, and evaluate your own one as well. The reason why this came up and the reason why I had Roger come and talk about it is that just someone who is in business recounted to me a story of an employee of his who they had a trades-based business, and this employee went and took the company ute out. Well, they had a number of vehicles. They took it out, and on the way home from the job that they were doing, they decided to drop into the local tavern to have a couple of beers. Unfortunately, they had a little more than they needed still, but they jumped in the ute and drove home, hit a Mercedes. It was a fairly, must have been a fairly new Mercedes, and it was a fairly expensive Mercedes as well too, and they wrote it off. And because they were over the limit, then the insurance company didn't actually cover the cost of repairs to the Mercedes or to the ute. So it ended up to be sort of close to $200,000 worth of damage, because it was, as I say, newish Mercedes and the ute. And so they didn't come after the employee, they came after the company, because the company was the one that had the money. The ute was owned by the company, and the company became responsible and liable for the not only the damage or replacing the damage to their own vehicle, but also to the damage to the other vehicle, actually replacing that other vehicle. So overnight, this became a close to $200,000 nightmare for this business here. Business owner sort of didn't have any control over this employee that went out and had a couple of drinks before they went home, and so they had to negotiate a settlement. And because everything was all retained inside this company, then everything was at risk. So, and this company had been around for about sort of 10 or 12 years, I think it was. And so potentially it was a disaster for the company. So the reason why I had Roger here to talk about that is that yes, the company is a great structure. but there are some important considerations about companies and sort of things to think about in terms of risk around it as well too. So hopefully that presentation was helpful. If you do have any questions there, definitely feel free to reach out to Roger. As I say, he does like whiskey. So, you know, if you did want to buy him a good bottle of whiskey, he's not averse to that there. But certainly good to talk to. All right. So now we do have a door prize tonight, do we not, Roger?
We do.
So tell us what that is.
I'd like to give away one ticket to the upcoming workshop, which tickets are selling at $347 per day. It is less if you attend both. I can't remember what the price is for both. It's $500 odd, but I'd like to offer one ticket. So the first, obviously, this first workshop is in Brisbane, but I understand that not everyone's in the Brisbane area. So I'll extend the prize to include, this workshop, if you're in the Brisbane Gold Coast area, so you can come and attend in person. But if that's not possible for you, then the prize will also be the second workshop where we're extending it to include online participants.
Excellent. So they can either come to the in-person event, or they can do just come to the online event, or they can come to the in-person and the online event.
That's it.
Excellent. Perfect.
Yeah, so it's a prize valued at around $550.
Perfect. All right, so we do have our wheel of names to draw this. So everyone that's here is in this wheel of names. Remember, you have to be in the room to win. So if you've disappeared, and you win, we'll redraw it. Actually, you won't know about it if you've disappeared, will you? Unless someone on the show actually tells them. So let's pick that wheel of names, give it a spin, and let's see who wins. All right, virtual drum roll, please. And our lucky winner is John Cutler. Awesome. Are you in the room, John? You're in the room. Unmute yourself. All right, give us a wave. Let me see if we can bring everybody up again.
John asked a lot of questions, so
he may have disappeared. Let me see him in the participants list.
I think he may have left.
He may have left. Oh no.
Bad move.
Well, what that means is we get to redraw it again. So let's spin the wheel again. Oh, hang on. Jennifer Lancaster says she's not in the list. Actually, I think you are. They did put you in it. If you're not, Jeff Field. Jeff, are you in the room?
I am indeed, Nick. I'm just in the middle of cooking dinner. Can you hear me?
I can hear you loud and clear. Excellent. Mate,
oh, congratulations, Jeff.
I'd like to, Nick, I'd like to donate my prize. I'd like to give it to Mark in New Zealand, if I could.
Oh, okay. Excellent. Excellent.
Because I'm over the Philippines. My taxes have been in good order. Thank you very much.
Very good.
I'll give it to Mark.
Excellent.
Mark, what's Mark's surname?
Mark Engstar. He's in New Zealand there. How are you, Mark?
Yeah, good. Thanks, Nick. Cheers, Jeff. It's very kind of you.
Oh,
yeah, you're most welcome, Mark.
Congratulations. Yeah, so unless you're about to fly over to Australia in the next couple of weeks, yeah, so we're going to hold these every 3 months, so it'll be the end of September.
Give me something to aim for, or
yeah, it'll be the end of September, so it'll be online as well as in person. The next one,
unless you want to give it, Jeff, to someone else and an Aussie.
Well, is there anyone ideally, it'd be nice for someone in Brisbane, Gold Coast, to come in a couple of weeks.
Yeah. Do you want to go, Nick?
I am already going.
Yeah.
You're already going.
Thanks,
all right.
Jeff.
Okay. Who else we got? I'm trying to see the list of names. Who's there? Oh, Nick.
What
you can either redraw, or
well,
you can
actually,
choose,
what I'm
Nick.
thinking is, that Jennifer Lancaster there said she's not on the list in the wheel of names.
Yep.
So I'm thinking if we give that to Jen, she lives in Brisbane, and she can go along. So how does that sound, Jennifer? Excellent. Thumbs up there.
Sounds nice. Thank you.
Fantastic.
You
Enjoy it, Jennifer.
you live in Brisbane, Jennifer?
Sort of. We're north of the river in Redcliffe.
Oh, yeah, I'm in Aspley, so we're almost neighbours.
Cool. Was it the 30th of June one? Was it?
30th of June, which is a Friday, and then the Saturday is the 1st of July. So they're completely separate. Like, I'm doing it with Pete Spinder, but you don't need to attend day one in order to understand day two. Like, they're completely independent of each other. Yeah, so if you've got something on, like if you can't attend both days, that's completely fine. You can attend. The day one will be e-commerce focused, like digital, and then day two will be know your numbers.
And if you haven't met Pete Spinder, he is an absolute master in this online area, the e-commerce and whatever. So yeah, well worth going to.
I'll definitely go to the e-commerce one.
Yeah. So Pete's very, very knowledgeable. We'll get him back on here again as well too at some stage. And Roger's also, as you can see tonight, very knowledgeable on the whole trust and structuring, which he's talked about tonight, but also the numbers side of things too. So well worth going to. So congratulations. Well, I'll connect you up with Roger tomorrow. We'll sort of do a joint email sort of thing, and then you can organise the tickets and how you get there. And
thank you, Nick. I'm always winning things. Thanks.
Excellent. And thanks, Jeff, for gifting that to Mark. Mark, thanks for gifting that to Jen. That's how we roll tonight. So
Christmas came early.
It has been indeed, yes. So if you enjoyed the presentation and you do want to watch it again because there are bits and pieces in there you want to catch again, it will be up on the YouTube channel, the Smash Go YouTube channel tomorrow afternoon. So if you just go to YouTube and search for Smash Go, or the link is in the chat, which reminds me, now's a good time to save the chat by clicking those three little dots at the bottom. That's got all of the links in there, plus that link there through to the YouTube channel. And of course, if you want any help with any of your online presence, your apps, your tools, your website, feel free to reach out to us at smashgo.co and happy to have a chat and talk about any issues that you might have, or even if it's just a question, any questions about trust, structures, companies, that sort of thing there. Roger's dropped his phone number into chat, so more than happy to entertain a phone call from you as well. And if you do want to register for that workshop as well too, then the link is in chat there to go and register for that. But apart from that, that's our session for tonight. So let's give Roger a big rousing round of virtual applause. Thank you again. And we'll see you back again next week, same time, same place. Go and have a good evening, and we'll catch you then. Thank you for tuning in and listening to the Business Owners Smashing It Online podcast. You can also find me on social media and online. Just search for Business Owners Smashing It Online and Nick Cree, spelled Nickcree, all one word. If you like this and want to hear more, subscribe now. Until next time, don't be a slave to your business. Get your business working for you.